hello, this short presentation will take a look at a few of the basics of chapters 2 and 3 and to help guide you through the transactions illustrated in these chapters. Let's take a look at the financial statements effect template. The FSET is a tool used to illustrate and itemize individual transactions. So what we see inside this template is a balance sheet and an income statement, and they are presented horizontally. Now first note that this is a very condensed form of the balance sheet. We only see two assets here. We see a cash asset, and then all other assets are lumped in this category of non-cash assets. Examples of non-cash assets would be accounts receivable, inventory, and equipment. Also, all the liabilities that might be present on the balance sheet will be itemized in the one individual liabilities column. On the far right, we see an income statement. Revenues minus expenses is equal to net income, and net income is then captured in earned capital. And so through the transactions presented in that chapter, you will see this. Now, net income is realized when revenues earned from the sale of products and services is greater than the expenses associated with providing those services. Finally, income that is earned can be returned to investors either as dividends or as kept inside the business for reinvestment. Finally, it's very important to understand that every transaction recorded in a financial statements effects template or a journal entry must balance. And so in the chapters, especially in 2 and 3, you will see that every individual transaction is balanced between the debit side and the credit side. So before we take a look at a few of the transactions in the NBS example, note the various accounts that will be illustrated and used inside the example, and this particular chart is presented on 47. So here we have a list of various assets. So notice we have cash, and then we have a series of non-cash assets that are itemized here. Also liabilities. We have a series of liabilities, obligations, mostly payables, and notice that these are all short-term liabilities. So within every transaction, you must ask yourself, what accounts are involved? And then what is the dollar magnitude and direction of each account that is involved in the transaction? Okay, so let's take a look at two examples of the transactions and see if we can break them down a little bit. In this particular transaction, number 5, the firm pays $670 cash for November advertising. So the first point is that the firm pays cash. So we have a deduction of $670 from the cash account. And then over here, we notice that we have recorded $670 as an increase in the account advertising expense. Right? So we are recognizing the fact that we have now spent $670 for advertising by recognizing that $670. This minus sign is implied. Okay? So we are not adding a minus sign here, but we're actually increasing the value of the account. And so notice that the transaction is in balance. A minus side on this side of the equal sign and a plus sign on this side. Then finally, in black, you will notice that we extend this out. So 0 in revenue minus 670 is a minus 670 income, which is then brought back over to earned capital. So let's take a look at a second transaction. This is transaction 8. Now the first thing to notice is that this transaction has two parts, 8A and B. And so what's happening in the transaction is the firm sells products. So they record revenue. They sell $2,400 of products. All right. Note that the sale is on account. So the customers will pay NBS at a later date. So cash is not involved. However, there is economic value that is owed to MBS, so it is shown as an asset, and it is recorded here in accounts receivable. So we increase the value of accounts receivable, and we record the revenue. And then we can carry out the transaction. The $2,400 in revenue minus 0 is $2,400 in net income captured over. However, since we moved assets, the MBS sold assets, they have to record that transfer of assets from the balance sheet to the expense. So that the $2,400 of revenue is attached to the cost of that merchandise was $1,700. And so $1,700 is removed from inventory and transferred to the income statement as an expense, cost of goods sold. And so for this particular transaction, we see that $2,400 of revenue less the cost of that product of $1,700 is actually a difference of $700, which is captured right here. So we've taken a look at just two of the transactions, and so there are a number of transactions for MBS presented in Chapter 2 and 3. And what you want to do is go through each one to seek the understanding of why it is recorded in the way it is recorded, which accounts are involved. And again, notice that the items in blue are the actual transaction. The items in black is actually the extension of the transaction through the income statement back to the balance sheet in earned capital. The last part of this presentation will just briefly discuss this concept of debits and credits, and we'll look at two of the figures presented. First, we see in this particular chart how increases and decreases in the balance sheet accounts are recorded in a T format. So notice the T, and on the left hand side of a T is always debit, the right hand side is always credit. Okay, and so that asset accounts increase on the debit side, and we decrease the value of an asset by making an entry on the credit side. Notice on the opposite side of the equal sign, both liability and equity accounts operate in the reverse. Increases occur as credits, and decreases occur as debits. Now the chart presented earlier is expanded just a little bit, and this particular chart includes both revenues and expenses on the income statement and shows you how to handle increases and decreases in those accounts as debits and credits. So here is the income statement, revenues minus expenses. All right. So these two charts are used to analyze, journalize, and post the 16 transactions for MBS illustrated in Chapter 2 on pages 60 to 65. And so within those pages you see both the FSET transaction presented earlier and then subsequently the journal entry right below it, and then the T accounts entries right below that. So notice in a journal entry that the debit is always presented first and the credit is presented second, and it is indented. Finally, on page 66, right, the general ledger presents each individual MBS account in the T account form with all debits and credits posted to the general ledger. Note the number in parentheses next to each debit and credit. That number corresponds to the actual transaction. All right. So hopefully this presentation will help you decipher some of the basics of recording accounting transactions in two different ways. One, the FSET, and then secondly, as well as a journal entry and T account.